How you doing, Eric? Are you all set up over there?
I'm all set up. I'm just making sure that my PowerPoint presenter view will work. And I'm excited to be here with you guys and have a good conversation. I have some slides to share and stuff like that, but we'll make this pretty interactive and less me talking at you and more us having a really fun conversation, learning about some cool ideas.
Very cool. All right, and I'll start off in just a moment with a couple of announcements.
Sounds great. Got a good crowd today. Look at all this.
Yeah.
It's fantastic.
Let's see. Last week we had 128 unique individuals on the line.
That's
So
fantastic.
we're still working our way. I usually don't start until we hit about 50, but or 12:05, depending on which comes first.
All good. All good. 12:05 Pacific time. And Daniel, remind me, you're in which state?
I'm in Oregon.
You're in Oregon. Okay,
Yeah.
awesome.
But a lot of the people that are here, there's quite a number of people in California. There's quite a number of people in the Oregon area. There's quite a number of people in the Arizona and Mesa Chandler area. There's people from Texas and Virginia, a couple from Idaho, and there's always one person from Italy, and I'm always curious who that person is. Every once in a while, I'll look at the map metrics, and oh, there's one guy from Italy.
Well, before the end of the meeting, everybody will have my email address. And if you're from Idaho, definitely ping me. I love that state. And hopefully eventually, up in the panhandle, hope to own some property and have
That would be
a
me.
summer place. That would be you? Dude, what a state, man. I love that place. I mean, I'm from New Hampshire. I'm sitting in New Hampshire right now, so totally opposite side of the country, basically Canada. And I love it, but man, Idaho, especially that panhandle area when you come over from Glacier and you've got, Lake Pend Oreille, and you've got Priest Lake and you've got Coeur d'Alene there, like in between Spokane and Montana. Some of the most beautiful country I've ever seen in my entire life.
This lake is nice.
I like that you say that. I'm actually probably going up there next week. We have a short-term rental house there, and I need to figure out how to reinforce the deck because it's sagging since we put a spa on it or a hot tub on it.
Ah,
So that'll be fun to do next week.
that sounds like quite a trip.
All right, it looks like we've hit our quorum here. So let me get started. Let me actually, first of all, start the live stream. So we're going to live stream this off the YouTube.
Awesome.
And of course, I think everybody here knows about our YouTube page, but if you don't, just go to YouTube, search Alternative Investing Club. We've got around 220 of our previous videos there, including most of the meetings that this club has done over the last 5 years. We're missing a few, like, oop, sorry. And as I launch YouTube, it's now echoing my words back to me. Okay, so let me share my screen. We'll do the announcements and we will kick this off. All right. So first of all, welcome everybody. I am happy that you're here and I hope that you're having a great week and looking forward to a great weekend. I did hear from a number of people that Intel is still got everybody in a little bit of a state over there, and that maybe next week would be a time where you guys would be hearing more about potential layoffs. So I'm with you in spirit on that. I think a lot of you know that I was part of the layoffs last year. My entire team was laid off, and so that's when I exited and left Intel. But if you're in a situation like that, first of all, I want to mention we've got two deals that the club is currently offering to everybody. The first one is the Alternative Investing Club Fund, and you can now go over to Alternative Investing Club Fund and club.com/fund. And you can see kind of the overview of the different strategies that the fund is involved in, including the first one, which is debt fund. Second, we're going to be investing into SaaS business equity, and then prefabricated modular construction. But each of these strategies is basically to be somewhat uncorrelated or non-correlated from other strategies, and they each need to have a unique business plan that makes it a workable, profitable investment in 2025. So that's what the goal of this fund is. And quite a few people have signed up here recently. So we're going to be placing our first investment that the fund is making into DLP Capital in the middle of next week. So if you would like to make sure that you are part of that, make sure to get your funds in before that time. You can just go here to this link and drop your information in here, and I will send you all the investor information. The second deal that we have currently available, and I wish I could put these oil deals inside our fund because these oil deals are really good, and they would definitely juice the returns in the fund if I was able to legally do that. But the reason why I can't is because these oil funds actually produce tax benefits that allow you to reduce your adjusted gross income. So they will offset your W-2 earned income. They will offset your capital gains income. And right now for this deal, we're actually projecting for every dollar that you put in, you'll get a year one deduction of 80 cents. So it's a good amount. It's not depreciation directly because it's not coming off of passive income. It's coming off your AGI. But it's business work expense deduction. So if you're interested in that, if you received a severance package and you are would like to take that, convert it into a revenue stream, and then get the tax deduction on it, this would be a great way to reduce your taxes on those. Here's our projected revenue just to show you really quickly, and I can send anybody who's interested the webinar as well. But it's a solid cash flowing type of investment, which depends on the price of oil, of course. But if oil is at around 70, and you invest $100,000, you're looking at around $5,455 of income per month. So it's a high income, high tax deduction type of investment. And investors we're projecting will actually get all of their invested capital back in a 16 to 18 month period. So it's a little nicer than real estate in that you get your investment back up front. With real estate, obviously, you're holding it during the time that the building is owned. So this has got a little bit of a different dynamic to it, and I think they're really good investments. So if you are interested in that, I will drop a link in right here to this form. There's a number of people that are actually part of this deal and helping to raise for this deal. I'm one of, what is this, 7 people that are on the general partnership. And so make sure you put down here that you came in through me. And if you have any questions, feel free to email me. With that, I'm going to turn it over to Eric. Eric, welcome here. I actually met Eric through my tax advisor, who's also been a guest on this podcast as well. And Mark, in fact, it was his presentation on this meeting that led me to actually decide to go with him as my tax CPA. And that's Mark Perlberg. And you can look up his talk on YouTube if you want. But Mark brought Eric Cooper to his group of people, and I usually log on to find out what's new in the tax world once a week from Mark. So that's how I found Eric. And Eric, why don't you introduce yourself to the group here, and we will kick this off.
Oh, I was on mute. That doesn't work too well. Well, hey, I love it. Thanks for having me, Daniel. And I'm really excited to be here. Been looking forward to it for a little while. My name is Eric Cooper, as Daniel shared with you guys. I'm the owner of the Sooner Private Financial Council based out here in New England, New Hampshire, and Massachusetts. And we do a lot with real estate investors. We do a lot with a lot of people, and we have a great relationship with Mark because advanced tax planning is a big part of what we do when we do financial planning. But ultimately, when we look at this thing that we're all trying to do, right, we're trying to build income freedom. We're trying to build generational wealth. We're trying to make sure we minimize taxes along the way. There's so many cool ideas and strategies when we put our heads together and we collaborate, right? The outcomes that come from collaboration are so much more valuable than what can come from individual research or what can come from just our own brains. So to be in a group like this with like-minded folks that are looking to build generational wealth and income freedom is really exciting for me. What I put together for you are some concepts that we're going to talk about today. I'm going to introduce myself a little bit more fully so that you know a little bit about who's talking to you. I'm going to share some concepts, and I have some slides to go through. But with a group like this, I really want this to be interactive, right? So feel free to, and maybe Daniel, you might have some suggestions on how we might be able to do that, the raise hand function or something like that. So maybe you could
Well, so here's what we typically do, and we can change
Okay.
this up, of course. I'm always game for that. But typically, we just have people put their questions into the chat, and then I'll judiciously interrupt you. That way, we don't have, five people trying to talk at once. Um, and
Perfect.
if the questions are slow or something, I can just say, take yourself off mute, and whoever speaks first gets to ask the first question. But yeah, we can definitely keep this interactive. If you want to, ask them to put, information into the chat, or however you want to do it, feel free.
Awesome. We'll start that way. We'll start with putting questions into the chat. I promise I'm not going to talk for the entire hour here. You guys would probably be super bored if I took all that amount of time. So we'll go through some concepts and then we'll have an open discussion. What we're talking about today, and I'm going to try to share my screen here. And if you could confirm with me, Daniel, that it's showing the presenter view, because from time to time, I have some challenges with that. I'm going to share my screen here and the alternative investing group. Okay. And I'm going to start from the beginning here. All right. Do you see the speaker notes view, or do you see just the share screen view?
Just the share screen view.
And do you see my slide changing here?
Yep, we do.
Awesome. All right. So we're going to talk about life insurance today. And we do a lot of things, but I thought that this would be a concept that's particularly interesting to you guys as real estate investors. I'm sure that you've heard about it before or talked to some folks about it before, but I want this education to be the most thorough education that you've had on using life insurance as a real estate investor, the way that it can impact your strategies, both in wealth building, in cash flow, in taxation, in estate planning, in acquisition, and carrying costs. There's a lot of different ways that you can use this to augment your overall wealth building as a real estate investor. So that's what we're going to be talking about today. And I'll share a little bit about else about what we do and ways that it might be helpful to you. But as mentioned before, this is me. I'm the founder and managing partner of the company. This is year 11 in financial services for me. So, didn't start yesterday, which I guess is good for all you guys, because I have all these years of experience and input and ideas that I can share with you. The one thing I'll mention here is that, the firm that we built and the reason why we're talking to you today is what we're really passionate about is connecting money with value systems. There's an infinite amount of stuff to know about money and taxes and strategies and investments. But how do we take everything there is to know about money and how do we connect that with why you care about money and your goals? And that's really the secret sauce on why we do this and why we do this kinds of education. As real estate investors, I think you understand this concept probably more than most. Really, what we focus on is change response. We can do as many projections as we want with your net cash flows and your carrying costs and your debt interest rates, and rentals and commercial markets and all these things that we want to do. But ultimately, when we make projections, they're exactly that. And the only thing that we know is going to be true is that the projections aren't going to work out exactly how we put it together. We don't control tax law. We don't control inflation. We don't control markets. So how do we use all these tools? And what we're going to talk about today is specifically insurance. But how do we use these tools, whether it's insurance or oil and gas investments or anything else, to make sure that you're agile to respond to changes in the environment, you're adaptable, you're agile, right? And how do we make sure we maintain control on your side of the fence by remaining agile in how you build your wealth? Our website is here if you want to check us out or check me out a little bit more after the call, and you'll certainly have an opportunity to do that. But that's what I have for you by way of introduction here today. What we're going to talk about here is we're widening our focus a little bit beyond some of the traditional investing strategies, right? And I think Daniel does a great job of that. So you guys have already widened your focus to an extent. But here's specifically what I mean by that. In terms of what we look at, right? And this is a little bit about our service model, which isn't really the point of showing you this graphic. But when we think about everything that you are trying to orchestrate in your financial life and the areas that life insurance could potentially hit, there's really 5 categories that we've identified really that we can take all of your financial goals or problems into, or buckets we can put them into, right? It's wealth management and growth. It's mitigating your risk. It's tax planning. It's business advisory, and it's legal services. And all these things, even though they're separate, there's a lot of overlap. And in order to create outcomes that you have control over and that you maximize the efficiency on, we need to coordinate. We need a team that is able to coordinate all these different things, which is why we have a virtual family office that we work with But life insurance can actually hit all 5 of these. So it's what I call the Swiss Army knife of planning. And we're going to get into that concept now. Before I do that, I must give you the required disclosures that I am not an employee of the IRS. All these examples are hypothetical. If you want to talk to me individually about your individual situation, you'll have an opportunity to do it, and I'd be happy to do it. But just make note of the disclosures on the call in front of you right now, and any investing decisions that you make are your own. So as long as we're okay with that, we'll get into some of the content. Now, I'm curious, and you can throw yourself off mute really quickly in order to answer this. But how many of you have, as real estate investors, have heard some sort of presentation or talked to some sort of insurance person about the uses of life insurance as a real estate investor? And if so, if you could just give maybe like a brief, 5 to 10 second summary of that, feel free to throw yourself off mute so I have some sort of idea of the starting point here. Don't be shy now.
Never heard of it.
Go right ahead.
I can tell you I've heard of it.
Okay.
So I've heard of it being used whereby, and I don't do it, so I don't know the exact mechanism, but the mechanism, as I think I understand it, is you use your life insurance, you borrow against it, and then that borrowing can be used to fund other investment activity, call it real estate or other things. And so you're essentially using that to buy the real estate, and then you are invested, and then you're just simply paying back that loan, which is essentially paying back yourself through, in that life insurance account. That's the part of it. I think that's my loose understanding of the mechanism.
Okay, thank you for that. Yeah, I mean that's certainly part of it. Now there's some other arms to that octopus, if you will, but that's certainly one of them. That as a real estate investor you can use to your advantage. Anybody else?
Yeah, this Gopal. So I think so whatever rate the actual investment is coming in, the policy it continues to grow even though you withdraw the money.
Yes. Okay. Yep. And that's what we call non-direct recognition underneath the life insurance policies, the concept you're talking about. That's certainly something that with certain policies can be part of the equation. So yeah, okay. So that gives me a good idea of where some of the group is starting from. And I'm sure this isn't probably the first time you've heard of it, but there's a couple different ways that this could be helpful to you, right? And we're going to start with taxation, and we're certainly going to get to the loaning part of it as well. But I wanted to show you this graphic to show you, this looks like the EKG is somebody that's about to die right here, right? I mean, there's nothing consistent about this graphic. And this graphic is a graphic of the top marginal tax rate for federal income tax since the institution of federal income tax. And really the only point that I want to make in showing you this graphic is there's a clear outlier. If you look at 1940 to around 1960, I think it was 1946 to 1970, 73 or something like that. You see how high the top marginal tax rate was, right? And as real estate investors, you're dealing with a lot of capital gains, and you're dealing with a lot of other tax forms that isn't necessarily W-2 income. But you see the top marginal tax bracket actually going over 90% and then staying at around 70% for a pretty long time. And the catalyst to this was really the amount of debt that we took on as a country, right? We had the Second World War, and we were in a high amount of debt. How does the government get a better job? They raise your taxes or they print more money, right? And our government happens to do quite a bit of both, which, if I were to venture to guess, is one of the reasons why you guys have decided to build a real estate and alternative investing portfolio. Now, when we look at the economic conditions, right, when the top marginal tax rate went to 91% in 1946, I believe for every dollar of income that we had, we had $1.08 of debt. Our ratio today is in the $1.20 to dollar of income, and our top marginal tax bracket is at 37%. Everything from the capital gains rates to the income levels to the tax rates themselves to deductions and credits, all of this is set to change at the end of 2025. That is the expiration of the Tax Cuts and Jobs Act, which was passed, I believe, in 2017. So basically, everything that we're leveraging from a tax perspective is up for renegotiation. And currently, if not renegotiated or chosen to extend, will revert back to 2017 rates adjusted for inflation, which are much less favorable to you than the current rates that we have. So part of the reasons we're looking at these kinds of strategies is I'm not an oracle and I can't guarantee the future. But when we look at economic indicators and when we look at history, everything from, capital gains to income rates to partnership income to the ways that some of these alternatives are treated, right? The way that we're trending is that these things will become less favorable. So what can we leverage where we can take money outside of that variability and take it off grid, if you will, from a tax perspective? And that's one of the reasons why we're looking heavily with a lot of our clients at life insurance right now, is because the economic environment from a tax perspective doesn't really seem to be showing that it's going to favor us moving forward for quite a long time. So when you are trying to build generational wealth that you guys are trying to do, I want to establish a baseline, right? You're taking cash and you're trying to buy assets that appreciate, and that obviously generate some cash flow as well. You're trying to minimize along the way how much you tip Uncle Sam. You want to minimize how much you pay financial institutions along the way, right? They want to maximize their fees. They want to hold your money as long as possible. And as an investor, you're trying to do the opposite of that. You want to control your risk and you want to effectively manage your liquidity, right? These are the 5 tenets to building generational wealth. As real estate investors, there's a lot of things that a real estate portfolio can hit here, and then some things that it puts you at a disadvantage for, which is why I think life insurance can be a unique tool for you guys to use. Here's one of the problems that we see, right? So when we think about this long term, naturally, as Daniel mentioned before, you have a real estate investment property, you hold the property, and it's largely illiquid, right? Over time, it appreciates in value, but you've got to pay a cost to access that value to a financial institution to access it via loan, or you've got to sell the asset. So you might be building a balance sheet that's not necessarily building liquidity outside of the cash flow. So a common issue that we see with real estate investors is these balance sheets that can be transferred generationally, or they can provide cash flow that can provide you some element of freedom. But they build the balance sheet to the point where you have an estate tax issue. Right now, the federal exemption, I think, is in the 13 million range. At the expiration of the Tax Cuts and Jobs Act, that is set to come down to like 5 or 6 or something like that, right? So when you build a real estate investment portfolio and you hold it for a long time, it appreciates in value, and you've had your debt paid off on it for quite a long time, it's very easy to hit those kinds of thresholds, particularly if you're talking about commercial buildings. So for long-time real estate investors, what we usually see is somewhere around 80% of the balance sheet being held in illiquid real estate, and about 15% in some sort of pre-tax vehicle, and 5% in some sort of tax-free vehicle like Roth, right? One of the challenges we run into if you're dealing with real estate is the estate tax problem. Because if you pass any of those assets generationally, which for most real estate investors is kind of the goal, there's an estate tax bill due if you're over the thresholds, and it's due pretty quickly. And typically the liquidity doesn't exist to satisfy it. When there's no life insurance in place, the only way to satisfy it is to liquidate an asset. So one of the reasons we look at life insurance, in addition to the living benefits, is to solve an estate tax problem where we can kill 2 birds with 1 stone. So keep that in the back of your mind as we go through some of these strategies and the benefits that they may have to you, particularly as a real estate and an alt investor. The second concept I want to share with you before we get into the life insurance is the concept of a tax-efficient allocation. Obviously, you've got your tax-free buckets, right? In the right circumstances, life insurance cash value you can access tax-free. Roth money is tax-free after you reach the 5-year qualification and after you're over 59 and a half. After-tax money is subject to capital gains taxes and also gets a step up in basis at death. And that tends to be more tax efficient than pre-tax money like pensions and SEPs and IRAs and 401ks that you're paying income taxes on ultimately when you access that capital. So temperamentally, your highest growth potential assets, where we can, we want to be concentrating them on the right. We want to be concentrating them in tax-free buckets. Secondarily, the second stop would be we want to be concentrating them in the after-tax buckets. And then the assets that you have that have maybe the lowest potential for growth but are the steady eddies, that's where we want to prioritize the pre-tax assets. If we have all 3 of these buckets allocated somewhat similarly, you could be losing quite a bit of money to the IRS and taxes, even if your risk is controlled, but simply because we haven't maximized the tax buckets. There's a lot of limitations to Roth money based on your income, based on a whole bunch of other factors and IRS law. there's limits to how much you can squirrel away in Roth IRAs, which are basically, based in the equity markets anyway, if we invest that money. There aren't really any limits other than financial underwriting to what you can squirrel away in life insurance. So as real estate investors, your cash flow is very irregular, right? You get regular cash flows from the rents. But when you're realizing the balance sheet, right? When you're realizing gains, you're selling properties, you're liable to come into quite a few windfalls of money in your life. And part of the challenge is there's not a whole lot of vehicles where you can put that money very quickly, where you're going to be able to shed some of that tax weight. Oil and gas investments that Daniel talked about is one of those things. But there's a lot of limitations to how much you can put into Roth IRAs. So one of the benefits of using life insurance is that there's really no financial limitations other than financial underwriting from the financial institution of what you can put into this kind of product. We're not dealing with $24,000 a year limits in a 401k or $7,000 a year limits as a regular investor. Really, it's just based on how much money you have and how much the insurance company is willing to give you. So there's a lot of flexibility when you can determine how much you want to stack up in this kind of asset. When we think about this kind of asset, primarily we're talking about reducing long-term taxes, okay? So micro tax planning is how do we reduce our taxes next year or in the short term? Life insurance can be part of that story, but it's ultimately not going to be the most effective tool to reduce your taxation next year. Where it's going to be very effective is the macro goal of reducing lifetime taxation. When we think about building generational wealth and financial freedom, how much can we reduce on how much you tip the IRS over the long term, not necessarily just next year or the year after that. So specifically, when we're talking about life insurance, we're talking about life insurance that produces some sort of cash value. Most commonly, that's index universal life insurance or it's whole life insurance. So I'm going to fly through some of the benefits here that they have to you as a real estate investor and how you can use it. And then we're going to look into some case examples, and then we're going to go to some discussion. The first thing to understand is that these are life insurance policies, right? So you can accumulate assets. They can essentially play kind of an investment role in a portfolio, but ultimately these are life insurance policies and they have a death benefit. There's a massive value to that as a real estate investor to have liquidity to settle an estate. And there's other ancillary benefits to life insurance. The main benefit to life insurance actually is obviously taking care of your family should anything happen to you, covering your debts, replacing income, and those sorts of things. The second thing with index universal life insurance specifically to understand is that the interest crediting rate is based on an external index. So the money's not really invested. You're not buying equities. You're not buying stock in these accounts like you would be in an investment account, but how the policy performs are tied to the investment markets. There's usually a cap on how much you can make and a floor on how much you can lose. And those numbers can change over the course of time based on the policy you have and the company that you have it with. But how much your policy makes is ultimately going to be determined by these indexing markets. So for somebody that has a lot of real estate's a pretty volatile and concentrated market. Equity markets can be very volatile over the course of time. So part of the benefit of choosing to accumulate wealth this way, when we talk about non-correlation, is we can set something that really has no investment downside where you can't lose money in the markets, but you can still kind of, in a secondary manner, kind of participate in market performance over the course of time because the interest that the company will credit your policy is going to be dependent on the equities markets. So good equities markets is good news for your IUL, even if you're not directly invested in those stocks. The downside risk is contained, but so is the upside, right? But when we look long-term, that downside risk being contained is very important to access to capital and also non-correlation to the rest of the markets that you're invested in. The money within a life insurance policy grows indefinitely tax deferred, okay? We'll talk about the taxes when you access it, because as real estate investors, that's something that's going to be very important to you. But something to understand is this grows indefinitely tax deferred. This is not subject to required minimum distributions when you hit 73 years old, like your pre-tax retirement money is. As long as you leave the money in there, contractually, they have to, there's a base crediting interest rate, so that it has to grow contractually. It can't not grow, right, over the course of time. And it grows indefinitely tax deferred, okay? So very important to note. The distributions, when properly structured, are tax-free. What that means in a nutshell is this. When you have cash value within a life insurance policy, you can access it tax-free via loans, as one of our attendees mentioned here in what he learned about using life insurance earlier. That is not the same as taking a loan from a bank. We'll talk about that in a moment. But those loan proceeds are tax-free. You are also able to withdraw money from these accounts in a non-loan fashion. You have the option to do both. When you take money out of the account, interest crediting is taxable, and dividends are not taxable. The reason is because dividends, technically from an IRS perspective, are simply a return of premium. The insurance company is returning some of the profits that they made to you as a dividend, which offsets your premium. So you funded it with after-tax dollars. Taking dividends out is taking out after-tax dollars that you already put into the policy. Interest is a separate thing. There are taxes if you access it via withdrawal. There are multiple situations why people would want to choose one over the other. What we see most commonly with these policies, particularly from a real estate investment perspective, is the use of loans so that it doesn't show as income and there's no tax cost on it. There's a carrying cost on the interest rate, but there's no tax cost to access it. So we're going to look at what that looks like in practice, okay? Now, this situation isn't necessarily something that you guys would be doing. Maybe for some of you it would be, but I want to show you the concept of how this can grow and how you can use it to access capital in a tax-advantaged manner. We're going to start with a couple assumptions. We're going to look at, and this is with Allianz, by the way. Allianz is one of the companies that writes these. We don't necessarily endorse them over other companies. There's plenty of companies that you can get these kinds of things through. But we just ran this illustration through Allianz because it was really good visually in illustrating the concept. So we're going to look at a 48-year-old that chooses to fund this policy at $50,000 a year for 17 years. Again, may not apply to your situation at all, but we're just showing the concept in terms of how it can grow, how it gets funded, and how it gets taxed on the way out. So we're going to look 48 and funding it at $50,000 a year for those 17 years, okay? What we're going to see here is if you look at this slide in front of you, the text might be small, but the summary of this policy, he's going to fund it with $850,000 over those 17 years. That's going to come out of his pocket, or if he's doing premium financing, which we'll talk about in a moment, it'll come out of a financial institution's pocket and then out of his pocket second. And what we're going to show is how he's able to generate about $4.2 million in tax-free income over a 25-year period after that funding period, right? So $850,000 of after-tax in, $4.2 million based on an average interest rate of 6.72%. Out of the policy. Here's how that kind of works. You see here on this illustration on the left-hand side, the premium outlay section shows that $50,000 going into the policy every year. It's important to note that since this is life insurance and there is a death benefit, there is a carrying cost to it, right? There are charges for the actual insurance underneath the policy, and we have to factor those in when we look at is this the net win for you? So if you look at the 1, 2, 3, 4, 5th column over from the left, that's going to show the total charges within the policy. And then if you look at the second from right, that cash value is going to show, the third from right, that current value is going to show the cash value of the policy as he continues to fund it. So you see the money goes in, there's some charges taken out, but over time, those crediting rates, as indexes perform, continue to compound the money in the policy. So by year 17, when he's done funding it, he's put in $50,000. So he's put in $850,000, and he has about $1.48 million in the policy. Modest rate of return, right? Not terrible, not the best that you could ever get in an investment. In life insurance, technically is not an investment, obviously, but pretty good return on his capital, right? But what we're going to do there, and this is the cool thing about loans, right? What we're going to do there is we're going to look at the net distributions column. So in year 18, you see he starts taking out $141,000 approximately out of the policy by way of loan. This money is coming to him entirely tax-free. And what's happening is he's loaning against the policy at a capped interest rate, and that interest rate is being charged to him. The interest and the dividends that the policy is getting paid, which are now pretty large because it had some time to compound, are covering basically the interest charges on the policy. So what we did is we just solved in this particular case, because this was a retirement planning case, where we said, okay, over the next 25 years, what's the max amount of income that we could reliably distribute tax-free without blowing the policy up? And what we found was we could distribute about $141,000 a year over the course of 25 years, ultimately resulting in $4.2 million of distributions. Even so, after those distributions, he still got an active death benefit of $2.7 million, which is lower than he would have had, right? Or actually, no, sorry, that's the wrong line. I want to show here, right? About $640,000, right? Because we're running this to a mortality of 95, even though the illustration goes beyond that, right? So he's still got a death benefit left, but at this point, if we continue loaning from the policy, we could get to the point where we overloan it and the policy blows up. A lot of these policies have overloan protections to make sure that we can't do that. And we use those pretty consistently when we're structuring these types of policies for our clients. But you see how this kind of works, right? The death benefit does go down as you loan to it, but because we're accessing this via loan, the capital coming back out is not taxed. It's important to note that when you're taking loans from these policies, there is no repayment schedule. You pay it back as you want to pay it back. Ultimately, if you've got an outstanding loan, whatever you have outstanding in the loan is going to be reduced from the death benefit when you die. And that's why you see the death benefit going down. So you can essentially collateralize the tax-free death benefit that exists after your death while you're alive. And that's how we can take the loans out in a tax-free, from a tax-free perspective. So this is something that if you want to pay it back, because you make more money by paying it back than not, you can, right? If you use this to fund a real estate investment flip, and then you flip it and pay the loan back and take the arbitrage, there's 1,000 ways that this can be used to your advantage. But it's very important to note, particularly as a real estate investor where cash flow is not always consistent. When and how you pay these loans back are entirely up to you. There is no contractual repayment schedule on them. And that is what makes this a really, really powerful tool. Now, if we look at this, right, this particular illustration showed us blending a couple different indexes, right? Some of them are stock-based, some of them are bond-based. So depending on how we want to expose ourselves to the interest crediting rates, there is flexibility within the policy. This is not necessarily just an S&P 500 kind of thing, right? So if you have concerns about, the large cap markets and where they are, there's a lot of different elements within these policies where we can choose interest crediting rates at the beginning. We can change them throughout the life of the policy to make sure that we're doing a good job managing the portfolio to target consistent returns for you as the investor. So this is just an example of a lot of the indexes that might be available in this type of policy. There are additional benefits to this type of policy that don't necessarily specifically apply to just real estate investors, but would apply to anybody that has this policy. One of those things is long-term care. A lot of these policies, you are able to access the death benefit while you're alive. If you do have a long-term care need, access that tax-free death benefit, for the purpose of the long-term care need, which is a pretty important benefit to have on a lot of these policies since it's hard to take care of that planning otherwise. The loan protection rider to make sure that we don't overloan the policy to the point where it blows up is an additional rider and benefit that occurs on a lot of these policies. So there's a lot of other ancillary benefits where you can kill two birds with one stone from a planning perspective. It's not really the reason we're talking about it today in this group, but I want you to be aware that it is a very flexible tool that you can use to augment a lot of different areas of your planning between risk mitigation, tax planning, wealth management, business advisory, and legal. Legal, we haven't even gotten to the trusts and all that kind of stuff. We can take that offline if you want to talk about that a little bit more. But if we want to see the impacts, or we want to see kind of the examples of, hey, if we were to invest this in a non-qualified tax portfolio, or if we were to invest this in additional real estate and, let's translate that to cash flows and let's look at the...
Hey, Eric, before you go into the examples, can I throw a couple of questions your way?
Please do. Yeah, I'm on a roll. Yeah. Stop me, please.
I know. I have to get a word in edgewise here. You're doing great.
Thank you.
Paulette is asking, can you talk more about IUL versus UL backed policy pros and cons?
Oh, yes. Okay. So the IUL, that I stands for index. And that's the type of policy where the growth is going to be based on whatever index we're tying the crediting strategies to. A UL is not really designed to be a great accumulation tool. A UL is more based on some sort of fixed interest rate, right? So if we want to reduce the cost that you fund the policy with, and we want there to be very little variance in how much you make, and we just want something that's going to pay a guaranteed 2 or 3% over a long period of time, that's a situation where we might use a UL. So a lot of times where we're using ULs might be a situation where we're essentially trying to buy a permanent term policy, and there's really no distribution plan from it. We're not really looking to access cash value. We just want to make sure that the death benefit sustains for as little money in as possible. If we want something that's going to compound and accumulate over time, that's going to give you leverage to loan from, withdraw from, right, and give you access to capital quickly and contractually, that's where we would look towards an IUL or a whole life policy. You know, there's arguments for both depending on the situation. IUL is going to have a higher ceiling than whole life. Whole life is going to have some more consistency. So depending on the funding amount and depending on the timing you're looking to fund it, that's when we look at those types of products. But a UL is not primarily intended for cash accumulation.
All right. Ramesh is asking, when funding an IUL, what happens if I can't fund 50K per year on one of those years during that 17 years of contribution? Does the policy blow up in my face? Do I lose all my previous contributions and growth? What happens?
That is a great, great question. These are flexible tools, so the answer is no, right? Usually there's a base amount that you have to fund it, right? And that's just the cost of insurance. So in the example that we showed here, I think that base amount was something like $7,000 or $8,000. And basically we were overfunding the policy for the purposes of accumulating money in it up to the MEC limit, what's called the modified endowment contract limit. There's limitations on how much you can fund a life insurance policy before the cash value becomes taxable. So a lot of what we're doing as a planning firm when we structure these strategies is how can we set this up so that you can fund it as much as possible with a cost of insurance that's as low as possible, right up to the limit where it's not taxable, but you're taking advantage of as much accumulation as you possibly can with the cash value remaining not being taxable. So what would happen is if, let's say, you know, you overfunded this policy, but you had a year or two where you weren't able to fund it, you would be able to use the equity in the policy to fund it. Right. So, you know, if you've got cash value in it, you could take a loan from the cash value to pay the premium. You could take the interest crediting rates or the dividends that year and apply it towards the premium. So kind of like a house, when you're building equity in the policy, right, you know, you've got some flexibility. Earlier on in the policy is really the key. If we set one of these up and you fund it year one and you can't fund it year two and you can't fund it year three, right? That's when we might run into an issue because we haven't really built up much equity in the policy to cover those premiums. But if we overfund it properly at the beginning, if we're just funding base premiums, right? You know, even in year two and year three, right? There's usually a lot of flexibility that we can have. So unlike a term policy or unlike, say, a whole life insurance policy that would require a premium every single year till the end of time, these policies, I mean, I've seen people overfund these policies and then not put any money into them for 6-7 years, and then dump a bunch of money into it when they sell a property, right? These are very flexible tools, which is one of the reasons why we focus on using them for real estate investors to the extent that you're realizing, you know, gains on an irregular basis.
All right. Prolette has 2 more questions, actually.
Cool.
Her first question is, what is the historical return since none of the illustrations showed the downturn of a market?
Aha. That is a great question. I'm going to ask you to put that one in the parking lot because we're actually getting to that in a slide here that's going to address that exact question and give you some visuals on it as well.
All right. And then she wanted a clarification. Are you saying that whole life cannot be structured for cash value?
Oh, it can. Absolutely, it can. UL is the one that's more difficult to structure for cash value. Whole life absolutely can. Whole life insurance is going to be based on a guaranteed interest rate and dividends. IUL doesn't have a guaranteed interest rate, but it's got some dividends and then it's got interest crediting strategies based on what the index does. So whole life insurance is going to be more of a steady Eddie, right? Here's one of the 2 main differences between IUL and whole life. The definition of a whole life insurance policy is that when the policy endows, which is typically at age 100 or 121 or 95, depending on what product and company you're dealing with, the cash value has to equal the death benefit. The onus to make that happen is on the insurance company, not on you. So no matter what the dividends that they're able to pay, like the insurance company has to price this so that based on the guaranteed interest rate within the policy, when that policy endows, the cash value and the death benefit are the same. In an IUL, that burden is on you, right? So let's say, and I'm not saying that this is going to happen. Historically, this hasn't happened. Let's say your index crediting strategies is in the S&P 500 are down 10 years straight, right? And we got no growth that we illustrated in the policy, and you're dumping money into it and it's not making anything, right? It's possible, or let's say you've just hemorrhaged money and withdrawals out of the policy and you haven't funded it in a few years. I actually did see this situation once with somebody that had a policy that was not structured correctly, and she was 96 years old at the time, and she had bought it in like 1988. And she hadn't been funding it for a long time, and she'd been depleting funds from it. You could run into a situation, hypothetically, this has never happened with any of our clients because we structure this so that it doesn't happen. But you could run into a situation where in order to keep the policy alive, you've got to put in 100 grand next year instead of 50, right? A situation like that. So we're leveraging the markets for interest crediting rates over the course of time so that we get the compounding. But if you run into a situation where you've taken too much out and you haven't been funding it and the markets haven't been cooperating with you, right? Ultimately, the onus to keep that policy alive and fund it enough to keep it alive is on you, not on the insurance company. That being said, realistically, if we're setting these up to overfund, right? And I'll show you this in this previous slide. For example, in this illustration, year one, 50,000 goes in and the current value is 43,000. Right? So it's pretty close, right? Even without any compounding, most of that premium is going towards the value because we are overfunding the actual, whatever the base cost of insurance is, we're overfunding it essentially up to that MEC limit so that we can get that accumulation wheel and compounding wheel started as efficiently as possible. So if we do something like this, the chances that you would have to basically make makeup contributions in order to keep a policy alive are slim to none. But that's technically the definition between whole life. And so whole life, we can structure it to overfund, and some people like the security of the whole life chassis more than the IUL. Before I go further, what other questions do we have?
We have a question from Anita. She
Sure.
says, for the example shown, what is the estimation of fees for comm management, carrying, etc., based on the projected age that you used, and what is the typical comm taken out of each 50K deposit?
Comm meaning commission?
Commission? Yeah, it might be commission. You want to clarify that, Anita? Okay, she says commission.
Yep. So whatever commissions, whether it's me or whatever firm writing it or whatever, those are baked into the underlying insurance cost. So there's not a direct commission that's taken out of. So if the cost of insurance for the death benefit is $8,000 and you're funding the policy at $50,000, the commissions are baked into that $8,000. That's part of the way that these companies will price the cost of mortality and, essentially their business projections to choose how much the insurance costs you. So I have a couple more concepts to share. I know it's 3:50, and I said I won't talk the whole time, and I'm on track to fail at that obligation to you guys. But I want to show you other couple cool concepts, and I want to introduce another one that might take some follow-up discussion, but I think is particularly relevant to this crew. So actually, let me exit out of this. I'm going to stop sharing my screen here, and I'm going to pull up something else to share if necessary. Let's see here. Okay. You asked about fees, right? So I'll start there. Because actually, I'll start with the downside, right? Hey, this didn't actually show the account losing money, even though it's tied to an index. What does it look like when it loses money? We'll take a look at this here, okay? One of the reasons why we use an IUL, if you're a real estate investor and you don't necessarily like the volatility of the equities markets, This is a scenario where we get to dip our toe in the water, but not be fully exposed to the volatility. Most of the index crediting strategies have a 0% floor in these policies, which means if the market's down, that doesn't get applied to your cash value. So you might have, say, an 11% cap or a 7% cap for the year on how much it can make. But if the market is down, you don't actually lose any money. Now, that doesn't include fees, which we'll talk about in a second. But if we're talking about what gets applied to the crediting strategy based on what the market does, most of these have a 0% floor. So it can really be a more secure way to grow money. So if we take a look at this example, and I think this example is using a hypothetical cap of 11% and a floor of 0, and we look at this over a long period of time, over like a 25-year period. If we're looking at the green, you see how this is more of a steady eddy? You don't participate in the top of the market. So over that course of time, you know, you've got a 6.4 average rate of return instead of 7.03 if you just bought the S&P 500 and tracked the index. But you don't necessarily have the fluctuations. So when it comes to things like access to capital or consistency of return to make sure that you're covering carrying costs on any loans that you take from the policy, it can be a much more predictable and useful asset because you're not dealing with the volatility. So this is something where part of the purpose is to protect you from the downside volatility of the markets, so that you can have more consistent cash flow and a little bit more control over the situation. Now, this one here is also important to look at, right? And this is a hypothetical example, and it's something that we've done based on our research is generally true. We would have to stress test your individual policy, right? If you were interested in this type of strategy to see what it is. But assuming the death benefit is distributed at age 90, right? As a average expense as a percentage of average policy value, 1.3 is kind of on the high side. Right? So we're talking about rider expenses. We're talking about mortality expenses for the actual insurance, right? And this does not include any surrender charges if you take it out, you know, if you cash it out like super early or something like that. But as a running expense, we're looking at about 1.3%. So pretty low, right? Kind of similar to a managed investment portfolio. You're kind of looking at, you know, if you have a, you know, ETF or individual stock portfolio that's managed by Wells Fargo or Raymond James or even me and my firm or something like that, right? A lot of those are going to be somewhere around, you know, depending on how much money you have, you know, 80 basis points to 150 basis points. You know, the average expenses at a percentage of average policy cash value long-term in these on the high side is about 1.3%. We would have to look at your individual policy to give you those projections, right? And obviously they are projections because how the policy performs, if it performs better or worse, can impact that number. But that's a general, I guess, rule of thumb when you talk about the internal expenses, right, that would be factored into that overall rate of return. Now, one thing you might be thinking, and if I were you, I'd be thinking it too, is, well, I may not have $50,000 every year to fund this. Some years I might, some years I might not. And who knows? I've seen people do this with $2 million a year. I've seen them do it with like $10,000 a year, right? So 50,000 is just an example. It's not necessarily the right number for you. But I want to talk to you about a concept called premium financing. The reality is a lot of your balance sheets are probably in illiquid real estate assets. So you might not necessarily have the cash flow every year to fund this to the level that you would want to. Maybe you have other cash assets that you would rather keep in reserve to purchase more real estate or to cover your illiquidity risk rather than putting it into a product like this that's going to take some time to bake to see that compounding return. That's when we get to premium financing. Premium financing isn't for everybody, but here's the basic concept. You can actually set these policies up where a bank that specializes in premium financing, of which we work with a few, is paying the premiums for you, and you owe the bank that money. The carrying cost to it that you're paying is the interest rate that the bank charges on the loan. Typically, these are 5 to 7 year loans, okay? So in that kind of scenario, maybe I'll just use the 50,000 for example. Maybe you can pay for it, but that capital has better use elsewhere in the meantime, and you work out a premium financing deal. The first thing that gets collateralized is the cash value of the policy. Typically, that's not going to collateralize the entire loan. So whether it's real estate or whether it's other cash assets, you're going to have to pledge some collateral in order to make this kind of loan work. Real estate's not collateralized at 100% of the value because it's an illiquid asset, right? So there'd be some sort of discount there. Cash would be collateralized at 100%, and there's a bunch of other assets that these banks can look at as well.
Hey,
But the
Eric,
general,
just a warning. We have 3 minutes left.
thank you. Thank you. Thank you. But the general idea is if we structure these properly, the cash value itself is going to pay off the loan. So imagine you're paying, you know, a nominal interest rate, 3, 4, 5%, whatever it is, and that's really your cash expense every year. You have a policy that gets funded to the max over a 7-year period, like I showed you in the illustration. So you funded it with $350,000, the cash value is $500,000. And at the end of those 7 years, the cash value of the policy itself pays off the bank. You end up with $150,000 arbitrage and an asset that's compounding indefinitely, right? And basically, your only cost to it was the carrying cost of the interest rate. So when we're dealing with these kinds of strategies, having it compounding every year and not being exposed to market downturns can be very helpful. I mean, imagine being able to finance an additional property purchase by borrowing from your life insurance policy, which is contractually guaranteed, no financial underwriting, no credit, no none of that, no collateralization, and not dealing with the bank. You can create those kinds of assets in some cases by leveraging a bank to actually fund the initial premiums. That is a concept that I've seen used very well to leverage acquisition of additional real estate cost, lowering carrying costs on interest, and a bunch of other strategies. So I have way more to share, but I'm out of time for you guys now. But if you're interested in this kind of strategy, both on how much it could save you in taxes and how it would fit in a real estate portfolio or premium financing, I'm going to throw in the chat 2 things. I'm going to throw in my email and I'm going to throw in my calendar link, so that you guys will be able to have that conversation with me whenever you want. But thanks for having me. I know I have maybe 30 seconds, so maybe we have time for one more question.
Well, let's start off by asking everybody to take themselves off mute and thank Eric for coming in and speaking to us today.
Thank you.
Thank you,
Thank
Eric.
you.
Thank you.
Thank you, Eric.
It's my pleasure, everyone.
Thank you.
I hope to be back. This sounds like a fun group. And Daniel, what I'll ask you to do, because I don't know if I have time, because I know people have to get places right at 4. Could I send you the calendar link in my email and you distribute that to the group? Is that possible? Or do we have time for me to put it in the chat here? I'm happy to.
Yeah, go ahead and put it in the chat.
Awesome. I'll put that in the chat right now. Life insurance is one of the things we do. There's a bunch of other strategies that you might be interested in too, but this one particularly. Aha, there it is. And here's my email, eric.cooper@soonerpfc.com. And looking forward to chatting with some of you guys.
Brian does have a question since it's in the chat right now. He's asking, he says he doesn't understand the dividend aspect. Is the dividend above and beyond the index part of an IUL?
Yes. Yep, that's above and beyond. So dividends are basically a return of premium. It's a way for an insurance company to offload some of their profits back to you, which helps you, and it also helps them from a tax perspective. That is different than the interest crediting rate that they credit you, right? Because ultimately what these insurance companies are doing is they're taking your money and your capital and they're investing it in all sorts of hedge funds and index, strategies and equity strategies, right? So there's a cap on what you can make. There's not a cap on what they can make. So how well their balance sheet does can impact the dividends, and obviously how well the underlying index does impacts what you get credited. But that's the difference between those two.
All right. And I think that's all for now.
All right, guys. Thank you so much. And best of luck to all of you, and hope to chat with you guys again.
Yeah. Thank you for coming in here, Eric. It's great having you.
You too. Take care, everybody.
All right. And I am going to end the meeting now.